hey everybody, it's great to see you again. Back here with Alon Ozer, Chief Investment Officer here at Omnia Family Wealth. So, hey Alon.
Hi everyone.
So, look, we're right here basically at the end of 2022. Let's say it's even early 2023 maybe by the time you're watching this video. I think it's been pretty clear what hasn't worked this year, and I'll say that it's been traditional stock and bond investing.
Right.
You would agree?
Yeah, absolutely.
So the idea, what we kind of want to talk about today is, so what did work in the last year? Very open-ended question. Why don't we just kick it off with that? So what worked in 2022?
The US dollar worked very well. Commodities, energy worked well. And some other strategies that worked well in terms of asset classes, just plain asset classes, not a lot.
So if we could talk about maybe those one by one, I want to start with commodities. Commodities are so interesting, right? Because I feel like it hit the news this year. Hey, inflation's a thing. We're dealing with 7%, 8% inflation. And at that point, correct me if I'm wrong, commodities had already run up so much.
Correct.
So how do you, we never try to time things, but how do you time something like that? When is the right time to be in commodities?
Right. So commodities are a tricky asset because it's very difficult to time them. There are funds that's what they do. For an asset allocator, you either have it as a permanent allocation or you express it in a different way. In our case, for example, we had a long-term allocation. It worked very well for 2 years, 2020, 2021, but then it got too big of a position that we had to cut it, obviously. But investors have to think that when you got to the point where we're already talking about inflation, commodities are probably already peaking, right? Because the Fed is starting to act, reducing liquidity, raising interest rates, commodities eventually are going to get hurt. So it's not that simple. You can't just try and time it. The other way to express it is through, and this is something that worked very well this year, is trend following strategies. Not all of them, some, it depends what type of strategy, but they have the ability to take advantage of commodities, long and short, different directions.
It's interesting. So you can be in, I always think of like, I guess traditional commodity investing as being like index investing, right? Where you're going long all the commodities, one big basket. But there are, I would say, some strategies that take some ideas from the hedge fund world, right? Going long and short commodities. So there's a lot of different ways, I would say, to express an opinion in commodities.
Yes,
to be dynamic throughout a cycle as you're doing that.
Absolutely, and probably a better way to do it is to take advantage of both. You have the direct exposure, you don't taking too big of a position in case you're wrong, and have the trend make their decisions.
Sure. So something else you mentioned, Alon, that's done well in the last year is US dollar.
Right.
How does your average, or somebody watching this video, investor, right, experience the benefit of a rising dollar, right? How does that play into a portfolio? How does it play into thinking?
So the US dollar is probably the most important. It's the most important currency, but it's probably the most important if we call it a separate asset. Because the majority of trade in the world is done through dollars, and dollar liquidity is becoming more and more important for different reasons. Maybe we'll get into it, but it's at the point where we really have to look at it. So if you want to take advantage of the dollar, you can use either an ETF or some other funds that are long dollar. In your portfolio, you are already investing in dollars, right? So you have the exposure, but you're not going to feel it unless you take advantage of something. Either you buy cheap European equities or emerging markets that got hurt from the US dollar. So you have to find a way to express it like that.
So just to key off of that for a second, right? So it's interesting. When the US dollar does so well, things that are denominated in other currencies have a headwind, right? And so some of the underperformance we saw this year in things like international equities, right, obviously have a lot to do with what's going on in that part of the world.
Right.
But there's also the dollar strength is sort of at play there.
I think that what the point that is very important to notice is that US dollar up everything else is down. US dollar down, everything else is up. It's a lot of liquidity. The dollar, when it goes higher, it gives us also a signal of problems with liquidity in markets. And it's not only the US, it's around the world. You have global companies that they fund their expansion through US dollars. When this is gone, then they have to scramble. They either have to close positions or they have to do whatever it is that they need to do. It's becoming a big problem. And I know it sounds crazy, dollar shortage. Right. We print money, we have, but it doesn't really work that way, right? It's not. It's more complicated than that. So the US dollar is something that's very important to look at as investors and understand the mechanics of why is it going to go higher, why is it going to go lower, and if it is, how it's going to affect my other asset.
So with any of these topics, right, I think we could do a full video, right? And so one just kind of popped into my head, which I think is different this year than has been for the last decade and a half, right? Short-term treasuries, right? The treasury market is like woken up again, and all of a sudden you can get 4%, 6 months, 12 months. How does that change sort of the psychology of investing? Is it a big deal that you can now get 4% on a short-term treasury?
Yeah, it's a very big deal. First of all, if you think about it, for the last decade and so, the Fed basically took away all the safe assets by lowering interest rates to zero, right? Mm-hmm. So they forced investors to take high risk to generate better returns. Suddenly you have short-term treasuries that are giving you 4%. At the same time, the market started rolling over. People are a little bit pessimistic, so they take advantage of it. So you see significant flow into U.S. Treasuries short-term, mostly what we call the on the run. So it's the recent auctions. It changes a lot, right? Because if a bond gives you with I don't know, a certain level of risk gives you 6%, and then the treasuries give you short-term give you 4%, it changes and it takes away from a lot of other investments.
Right. So it's very much the opposite of what had been going on for so long, where the Fed's like, listen, we're not going to pay you anything in short-term treasuries. Go find return somewhere else. Now that there's return in treasuries, it's starting to maybe take the air out of some of those, we'll say, more speculative markets, 100%. Where there's less internal cash flows and less there. So it's, I think, been a very interesting 2022. We're going to take a pause right here because I think this has been a great conversation. I want to thank you as always for your time.
Thank you.
And we'll be right back with another part talking a little bit about what we're looking at today and maybe what to look out for in 2023. Thanks so much for watching. As always, make sure to rate, review, and subscribe. You can also find more content on our Omnia Family Wealth YouTube page or check out our latest videos by clicking on these links.